Hi, everyone, and thank you for joining our latest installment of Global Conversations. My name is Catherine Segura, and I sit on the corporate communications team here in New York. We're delighted to have Tina Byles Williams as our special guest today. Tina is CEO, Chief Investment Officer, and founder of Xponance, a $12 billion multi-strategy investment firm, which is also one of the largest diverse and women-owned in the United States. Tina also serves as lead portfolio manager for the firm's active global equity multi-manager strategies and is a member of the investment committee for the firm's private market strategies. She founded FIS Group, the predecessor firm of Xponance, 25 years ago and has over 36 years of investment experience. Prior to Xponance, Tina served as Chief Investment Officer to the City of Philadelphia's Board of Pensions and Retirement. Anthony Maniscalco, who is head of Investcorp's Strategic Capital Group, will also be joining as moderator for today's conversation. Launched in 2018, the Strategic Capital Group provides capital solutions to mid-cap private market alternative asset managers. In April 2021, earlier this year, Xponance and Investcorp entered into a strategic partnership to collaborate on GP staking and seeding of diverse and women-owned alternative asset managers. Tina also serves on the advisory board for the Strategic Capital Group. Today, Tina and Anthony will discuss the evolution of the institutional asset management space, lessons learned over the past 25 years, and what will be top of mind for investors in the new year. Thank you all again for joining us today. I will now hand it over to Anthony.
Thanks, Catherine, and Tina, thank you for participating today. I also want to say it's been a real pleasure being your partner. With that, I'll start with some questions on your background. You funded your business through an SBIC loan secured by the equity in your house. Tell us a little bit more about that.
Well, first of all, right back at you, Anthony. It's been an extraordinary experience working with you and the team at Investcorp. So based on my experience as an asset owner CIO in the early 1990s, I was quite confident that investing in boutique investment managers would provide a differentiated path to alpha in an industry which valued focus, well, rather scale over focus and comfort over performance. But back in the mid-1990s, access to conventional funding sources for a startup investment firm run by a Black female entrepreneur would have been the very definition of an oxymoron. And so I was fortunate to be introduced to a visionary investor who ran an SBIC, who, by the way, sits on our corporate board today. But I will say that while collateralizing the loan through my house was risky, it also meant that failure wasn't an option because it would have meant both unemployment and the loss of my home.
Wow. Prior to launching your own firm, you came from the institutional side. As mentioned, you were at Philadelphia's Board of Pension and Retirement. How does that experience as an allocator inform your work today?
Our mission at Xponance is to be a highly valued investment partner and to be a force multiplier for positive change in the investment industry. Both parts of that mission were informed by my stint as an allocator. First, it taught me to place myself in my client's shoes, to listen actively to what they're trying to achieve and not just push products. The second part speaks to the alpha potential of diversity. As an allocator in the late 1980s, early 1990s, all the firms presented to me for investment consisted of white men who came from very similar social, cultural, and academic backgrounds. As an investor, this seemed to violate what I learned as the fundamental law of success in active management, which states that performance is a function of selection skill, as well as the breadth of independent opportunities for investment, which is why studies show that diversity improves performance. Moreover, I believe and continue to believe that race and gender bias diminish return possibilities. If you think of, and I apologize to the global audience, but America's Major League Baseball in the early 20th century, which missed many incredible talented Black players such as Satchel Paige, who Joe DiMaggio described as the best pitcher he ever faced on the mound. Bias not only robbed Satchel of a Major League Baseball career, but American baseball was impoverished by excluding the greatest pitcher to have stepped on the mound in his heyday. And so then the question is, how many brilliant people of color or women that might have equally been transformative did not get an opportunity to pursue their chosen career because of bias?
That's great. Xponance turned 25 this year. First of all, congratulations on that. How has the firm's focus evolved over the years to meet investors' demand?
Well, thank you. And yeah, we have evolved quite a bit over the last 25 years. Today we manage about 14 billion, and we've evolved either organically or through strategic acquisitions from a solely multi-manager shop to the addition of direct management of bond and equity strategies, and more recently from offering public market strategies solely to the addition of private market strategies through a partnership with Investcorp. The anchor underpinning all of that evolution is the core mission that I just mentioned. But our strategic direction has been driven by a combination of listening to our clients, understanding their investment objectives and challenges, as well as an affirmative action to two basic questions. First, will the new strategy be a valued addition to our clients' portfolios? And second, do we have internally or can we acquire the resources externally to compellingly and competitively offer any given strategy?
Great, thanks. Thank you. What risks are top of mind for your institutional clients today?
Well, let's first acknowledge that the curtain is closing on the easy money era everywhere. But as I talk to clients, the things that I hear most frequently are obviously the combination of negative real interest rates across the developed world and relatively high US equity valuations. Negative real yields on bonds obviously mean that much of an investor's portfolios are now producing unacceptably low returns. And more limited diversification. And then high equity valuations likewise reduce expected future returns. So a market cap weighting approach, which most institutional investors, a good part of their portfolios in market cap weighted index fund, actually increases this vulnerability by causing them to hold more of the same assets that are now yielding less. So that's a huge challenge. The second is, the risk of a more structural de-anchoring of inflation expectations. Market consensus, if you look at the yield curves here or even in Europe, suggests that inflation will normalize to 2 to 2.5% after supply-related distortions have been resolved. But a self-reinforcing wage and price increase spiral could lead to far more pernicious and structural de-anchoring of inflation. The third is climate change, which will likely be one of the defining issues of the 21st century and affect us in unanticipated ways. Thus far, decarbonization is proven to be expensive, inflationary, and is actually leading to acute natural gas shortages in Europe. And so the irony of decarbonization is the beneficiaries thus far have been national energy producers that are less susceptible to moral suasion by institutional investors such as Saudi and Russia, and as well as natural gas and oil producer companies. So until the energy infrastructure can accommodate more renewable resources and incorporate them into baseload power, these frictions will exist. And then the final and fourth risk, of course, is China, which, could arguably be the biggest risk or the biggest opportunity. And specifically there, the question is how will growth, commodities, and geopolitical risks be affected by another great power rising to challenge the existing order? Or I guess, how will global commodities and financial assets be impacted by China's attempt to rebalance its economy towards higher value and greener production and consumption?
Great. A couple follow-on questions from that. You've done a lot of research on the impact of inflation on investors' asset allocation models. What are some of your conclusions from that?
So our research suggests, and this is kind of the challenge with a more structural increase in inflation, is that the benefits of diversifying stocks with bonds diminish in higher inflation regimes. So, for example, during the high inflation period of the 1970s, and then the joke in our office, I don't know if it's the same in yours, is that most of our research staff have no idea what high inflation is. But anyway, so during the high inflation periods of the 70s and 80s, stocks and interest rates were negatively correlated, which means that stock returns and bond returns were positively correlated. What changed that, of course, is, Fed Chair Volcker's sort of war on inflation, which ushered in the current era of falling and stable inflation, in which asset prices have primarily been driven by earnings growth or the readjustment of the risk premium associated with changes in market liquidity. Inflation has been sort of a non-issue, if you will, as it relates to asset price. So consequently, the era we are used to is stock prices and bond yields have been positively correlated, which means that stock and bond prices were negative correlated, and therefore it was really easy to diversify, equity holdings with bonds. But if we return to that era of higher inflation and negative rates, asset allocation models underpinning retirement plans and the hugely popular target date products that manage stock and bond allocations over a glide path and they represent something like, I think it's 30% of DC assets. They could be really challenged.
Great. So the second follow-up question then is around China and how investors should be thinking about the uncertainties with China right now.
China's equity markets have had a rough year because of policy austerity as well as widely reported regulatory changes. Although it's well worth mentioning that, while Chinese equities had a drawdown, they were almost completely offset by a rally in Chinese bonds. But more importantly, for long horizon allocators, China is just too big to be avoided. China's geopolitical ambitions, economic rebalancing, and its recent regulatory clampdowns signaling a greater focus on so-called common prosperity obviously presents some risk. But I would remind investors of a similar period of antitrust backlash in the late 19th century and early 20th century in the US, which targeted monopolies in the oil, railroad, and other industries, as well as the fabulously wealthy families like the Rockefellers, etc., behind them, which ultimately renegotiated the country's social contract. So, I think that it looks a little different in China, but it's sort of a natural sort of evolution as an economy evolve. And at the end of the day, this adjustment, as it did in the US, will create new winners, new losers. But this is why we think skillful and informed and nimble security selection will be key going forward.
Great. Getting a little bit more micro, as a multi-strategy firm, where are you seeing the most compelling opportunities from an asset class perspective?
Yeah, so over the last decade, global diversification, quite frankly, hasn't paid off, hasn't lived up to its billing. It's been way more profitable to just stay in the US and non-US investors to invest in the US. But we think that's changing. Both the US and Europe have issues, stretched valuations in the US anyway, rising debt and rates, inflationary pressures, limited monetary fuel, and internal conflict. For Europe, it's the same thing, just extract the demand and valuations. Emerging markets do provide a compelling opportunity on both the debt and equity side. The other thing that's interesting is our researchers noted that publicly traded EM equity markets are actually deeper than DM markets now in terms of the number of liquid and neglected stocks. And China is a great example of that, where it's now the largest market in terms of the number of investable publicly traded stocks. But, we don't expect that rotation to occur until China's pivot towards sort of further policy easing moves through the system or gathers steam, which we expect to happen in the second half of 2022. And in the interim, China's slump will continue to keep the dollar strong and cap the upside in treasury yields and support US assets.
How about specifically within alternatives? Where do you see the most value there right now, especially as you yourself move into that market?
So, we had thought long and hard about it because there's a lot of money, as you know, chasing private markets. But we do see pockets of opportunity, and that's where we've kind of planted our stake, if you will. Obviously, with decarbonization, one would expect outsized returns for investing in breakthrough renewable energy technologies, as well as adapting the power grid to accommodate renewable energy sources, which leads me to infrastructure funds, which are not only less trafficked by investors, but also can provide some inflation protection. Additionally, private credit strategies such as special sits can provide enhanced yields in a yield-starved world. You know, through our and Xponance, through our partnership with Investcorp, we're seeing tremendous opportunities through our investments in mid-market GPs and emerging GPs. As you know, there's lots of research that suggests that those segments have exhibited more competitive returns than the mega funds that attract most institutional assets. And we like the space because these are usually founder-led GPs that are highly leveraged to the success of their business and their fund offering. And additionally, some of the most compelling opportunities in the mid-market and emerging GP space are sponsored by diverse and women-owned GPs whose proprietary deal flow in differentiated markets can provide additional alpha.
Great, thank you. A little bit along those lines, how have you seen client expectations around ESG evolve, and how are you incorporating that into your own investments?
So multiple crises over the past 2 years have delivered a stark wake-up call that if we're going to successfully mitigate pandemics, reduce the risk of climate change, and build a more equitable society and still generate growth, we'll have to create a more sustainable economy. And so ESG issues have gone from a specialist product targeted towards a minority of investments to the center of corporate strategy and as being considered central to value creation. With respect to Xponance, we are all in. It is central to our corporate strategy. On the investment side, our systematic global equities platform incorporates ESG factors into their investment processes. And we're really excited. We recently launched a unique strategy which incorporates both climate risk and DEI factors through an exclusive agreement with a shareholder advocacy group, which scores publicly traded companies on their racial justice profile. That appears to be really embraced by the institution. It launched in November and has gotten quite a bit of take-up in the institutional community. Our fixed income platform also evaluates ESG risks among corporate issuers and incorporates green bonds. And finally, on the private market side, we've found that some of the best of class emerging and mid-market firms, as I just mentioned, are diverse and women, and some of whom offer impact funds that leverage differentiated markets.
Great, thank you. Over the last year and a half, there's been increased focus on DE&I. What changes are you seeing in the industry?
You know, I've seen so many ebbs and flows in the investment industry and on this topic. Perhaps the greatest change relative to my asset owner days is the availability of data to measure the progress of the industry. On that front, last week, the highly respected Knight Foundation study on the distribution of institutional assets and the relative performance of diverse managers was released. Despite, again, finding no performance differences, firms majority owned by women and diverse professionals controlled only 1.4% of the more than $82 trillion managed by US asset managers. That represented a 0.01% growth since 2019. So, on the top, it looks a little disheartening, but if you dig below, you get some sort of more useful information. So one is that the AUM managed by diverse managers is disproportionately in managed account. But 91% of the AUM analyzed by the study represented mutual funds, which are expensive to form and therefore, represent a barrier to entry, if you will, for most diverse firms. Therefore, as I spoke to a report on this study yesterday, in order to really move the needle, we clearly need to see greater penetration of diverse managers into mutual fund channels, such as DC plans, stable value, OCIO, and wealth management platform. And the other thing I'd say that there were some hopeful signs. A Knight report reported that assets managed by diverse-owned firms grew at a faster rate than the overall industry, particularly for private equity. And I suspect if they just segregated managed accounts, the growth would have looked even more robust. And again, the study found that women and people of color perform at par with white men, and thus they concluded we don't have a supply problem of diverse talent, we have a demand problem, and that is a conclusion in which I can agree.
Great, thank you. What is one of the most critical lessons you've learned being a Black woman in a male-dominated industry?
So that requires a Dostoevsky length novel, but I'll try and shorten it given the time. I would say, get comfortable with being the only one in the room, and then turn that spotlight into an advantage by shining. The second thing I would say is breaking barriers is not for the faint-hearted, but the thing that one needs to guard against is the more pernicious problem of allowing those who doubt your competency to live rent-free in your head, and let their limited perception of your potential define you. The third is to be strategic. Try to maintain your composure. Yes, you're going to face microaggressions, but not every microaggression is worth a full frontal response. And finally, be kind to yourself, your loved ones, because it's going to be tough, and to others, because you'll need all three.
Excellent. Well, thanks for that. What's one piece of advice you would give to a young professional today?
Don't give up. General Paul, who also bears Jamaican roots, said, "It ain't as bad as you think, and it'll look better in the morning."
Excellent. Nice piece of advice. Xponance is known for working with and supporting emerging and diverse-owned managers. What do you look for in a manager on your platform?
Well, a durable hunger. And what do I mean by that? That, a rare combination of ambition and the wisdom and patience to stay the course when the winds aren't at your back. Second, obviously, an investment edge, either through proprietary deal flow, differentiated security selection, or more efficient portfolio execution. Third, intellectual curiosity paired with humility. That means that if you're confident that your position is right, and we all are, right? Be genuinely curious about why other smart people see things differently, because it will add depth and dimension to your understanding. Fourth, an ability to not only glean valuable lessons from adversity, but to grow stronger and wiser as a result. And finally, and really importantly, an ability to attract, inspire, and retain the best from those around you.
Excellent, excellent. Have there been mentors or sponsors that have really impacted your career?
Yeah, both are women. The first was a woman called Patricia Garrison Camp Corbin, who sadly has passed, but she founded a nationally respected financial advisory firm in the 1980s. And she actually prepared me most acutely for the challenges that I would face as a Black woman founder of an investment firm. The second was a client, Denise Napier, who as treasurer of Hartford and later Connecticut, believed in me early on and was key to launching my business.
Excellent, excellent. Your firm has been awarded Best Place to Work by P&I 2 years in a row. What's your secret to keeping employees happy, especially as we navigate the Great Resignation?
Hire well, treat people with respect, give them the opportunity and space to rise to the level of their own individual ambition and capacity. And most importantly, imbue them with a common purpose, which energizes and challenges them so that they're excited to work with you. The biggest mistake people make is, and money is important, no denying that, but you can never win that game solely through money. Because certainly for us, there are many firms that can throw way more money at our folks than we can. And so energizing them with your purpose and having them really sort of sign on has worked for us and we think is important.
Excellent, excellent. So I'm going to finish it off with some rapid fire questions. And first thing that comes off the top of your head. First question is favorite city.
This probably, believe it or not, Istanbul. Well, at least when I visited it 6 years ago. And why is that? Fascinating juxtaposition of Eastern and Western cultures and really rich repository of significant cultures, the Greco-Roman culture, the Byzantine, Seljuk, and Ottoman Empire.
Recent book you read?
Colin Powell, actually, his, and the specific book was My American Journey. Was a remarkable man who also had Jamaican roots, who rose to prominence through grit, wisdom, discipline, and character, and who, like most of us, made some tough decisions that he later regretted, but to the end remained a great patriot and maintained an unimpeachable character and poise.
Absolutely. Next travel destination?
For business, everywhere.
Fun, pleasure.
Play, Greece.
Nice. Favorite meal?
Ackee and codfish, which is the Jamaican national dish. Looks like scrambled eggs, but it's awesome.
How's that made?
It's made from a fruit that it comes in a pod, and it's only, I think it was transported to the islands through the slave trade, but it comes in this pod that if you don't know what you're doing, it actually can be poisonous. But it's but so make sure someone prepares it that knows what they're doing, but it's delicious.
Winter or summer?
I'm a daughter of the Caribbean. What do you think? But I'll say summer.
Okay, all right. Same here. Pat's or Gino's cheesesteaks?
So neither. And my blood vessels and heart are thanking me greatly for that.
Excellent, excellent, Tisha. Well, with that, thank you, Tina, for joining and being an incredible sport and sharing all your thoughts and on markets, on leadership, on perseverance. I also want to thank everyone else for zooming in. We hope you found it informative. And lastly, happy holidays. Be safe. And again, thanks for zooming in.
Thank you. Thanks for being such a great interviewer.
You're welcome. All right. Bye-bye.
Bye-bye.